bring in Bloomberg Intelligence Senior Analyst of Logistics, Lee Klasko. Lee, thanks very much for joining us.
Hi, good morning.
I know it's tough looking at these CN Rail earnings in the sense that the BC port strike was a one-off and floods and wildfires affected the quarter. But was there a clear picture for investors here?
You know, I think so. I think what CN has proved is that, they are looking at continuing to improve their overall operations, even though they missed earnings expectations by a couple pennies, a couple cents. It really was a decent quarter because they did face a lot of headwinds. Not only did they face the headwinds that you just mentioned, from Mother Nature, whether it's floods or fires, and also from port strikes. They also faced a headwind from the lag in the fuel surcharge that they charge their customers, because when fuel rises very quickly, it becomes a headwind. And if you compare it from the third quarter of last year, it was a 20-cent headwind. I mean, all rails are dealing with it, but it's something to consider as well. Their fluidity wasn't great either. And when I say that, I'm talking about their operations, whether it's their train speeds or their dwell times. They both deteriorated slightly. But that's to be expected because, like we mentioned earlier, they were dealing with floods and fires on their network. I think what people are really focusing on in the near term is whether or not they can make their implied earnings guidance, which we put around roughly $1.80 to $2.10 in the fourth quarter. Consensus is around $1.95. So really, it depends. I think that if you believe that volumes will start to tick up from the third quarter, they can easily make their guidance. But if you believe that maybe volumes might not be there, it might be difficult for them.
Now, if you look at, let's say, one particular segment, that's the consumer goods, the shipments related to consumer goods, any read-throughs? Now they've slowed down in the quarter, and they've been slowing over the last a little while. Any read-through, like broad read-throughs to the Canadian economy as a result of that slowing?
I mean, there's good news and bad news in those numbers. Their automotive volumes have been pretty strong, and that's really been because of pent-up demand for autos, given what happened during the pandemic. I think the industry is still working through that. Obviously, the strike at the UAW, and that could have an impact on volumes if that strike lasts for a long time. Obviously, that would impact volumes pretty negatively. On the intermodal side, which is containers, and it's more of a truck competitive product, you've seen them kind of getting that market's been better for them because they have been able to improve their service. Canadian National really pivoted back towards precision scheduling railroading about a year or so ago, and that really has paid dividends for them because they need to have a consistent product and a consistent service to be more truck competitive. And that's really a secular growth opportunity for Canadian National and the North America railroads.
I'm always interested in precision railroading because doesn't it involve imposing discipline on customers as well? They tell suppliers, you've got to have your goods ready to move at the time we agreed.
Yeah, I mean, just think about it as an airline. If you want to go across the country, you need to be at the airport at a certain time and get on the plane at a certain time, otherwise you miss your flight. Mm-hmm. So they're just trying to operate that way. It can be burdensome for the shipper at first. But most of CN's customers have been dealing with PSR for a long time because Canadian National really was one of the first railroads to implement that. 30 years ago.
Yeah, apparently in the old days, a lot of freight really wouldn't have a timetable. It just moved when the train was loaded.
Right. They would try to build long and heavy trains, and once they got to a certain length or weight, they would let them go.
Lee, we'd better let you go, but thank you very much for joining us.
My pleasure. Have a great day.
Oh, that was Lee Klasko, a Bloomberg Intelligence Senior Analyst in Logistics. Let's have a look at some of the big winners and losers yesterday on the TSX Composite. You can see Lithium Americas bouncing back. Now, lithium, it and other lithium stocks have been out. of favor amid fears of a possible glut in lithium with so many new projects coming online. But it looks like investors moving back partially into lithium Americas. Tilray Brands, always volatile, and it up around 9%. TFI International, the earnings there slightly below expectations, and Tech Resources down. Wow, it looks like the sell-off deepened through the session. Endlessly rising costs at their huge new Chilean mine. They also cut production guidance on both copper and coal. Let's have a look at Microsoft. People delighted, it seems, with the cloud results from that company. Of course, cloud providing massive computing services or platforms for other companies to use, seen as a crucial growth area. And Alphabet, aka Google, moved in the opposite direction. The cloud results there disappointing investors. And let's have a look at the metals. Moving on there, yeah, you see gold holding steady, but it has been down over the past 2 days. Investors wary of further rises in U.S. Treasury bonds. Higher bonds or higher interest rates generally seen as bad for gold. We did see gold hitting its highest in 5 months last week as investors sought out havens amid this Israel-Hamas war. And let's have a look at oil. Oil holding its own, but of course we have seen it spiking up to around $90 US over the past week or so, following the October 7th attacks by Hamas on Israel. And you can see Western Canadian Select down about 4%. I think that could be from yesterday, but I'm not 100% sure. And all this is interesting. Look at that. Microsoft and Alphabet pretty well neck and neck over the past year, but in the pre-market, Alphabet saw some selling. Let's bring back our featured guest, Anish Chopra, Managing Director at Portfolio Management Corporation. Rail stocks, are you an investor in them? I mean, CN Rail down about 9% this year.
Yeah, we're investors. We do own CN Rail, but if you take a longer view than just the most recent quarter, is the Canadian economy going to grow? Is the U.S. economy going to grow? Is the GDP of, let's say, North America going to be greater in 10 years than it is today? That's the view we like to take. That doesn't mean that we're not going to go through some periods where things aren't as rosy. And on the shipment side, in the rail business, it's a really tough time between port strikes, economic slowdown, and it's going to take some time to recover.
What about the tech names? Do you like Microsoft?
We do own Microsoft, so certainly we're happy with the pre-market performance. But when it comes to Microsoft, I think what's important is as artificial intelligence, as AI has really started to take off, Microsoft has actually been able to put it into its products, and I think that's really driving adoption of Microsoft products, helping sales of Microsoft products. So when you look at it, being able to adopt AI and the value that AI provides to users as quickly as Microsoft has been able to has been a boon for Microsoft.
Wow, I'm just looking at a 5-year chart from Microsoft. It has been a great name to own. Your return, you've more than doubled your money over 5 years, whereas on the NASDAQ 100, you've trebled your money, whereas on the NASDAQ 100, you've doubled your money just about. So big returns from Microsoft over the past 5 years.
And I would say that's across all the mega cap tech stocks. Generally, the stock price performance and earnings growth has been solid, but when you look at them, one of the issues is that for, let's say, Microsoft or Apple, let's say you go back a little further than 5 years, let's say you go back maybe 7 years, one of the things was that maybe these companies can grow again, and as a result of the investor thought process that these companies can grow, the earnings multiple fell, right, to very low double digits, high single digits, right? So you're looking at Apple at whatever, let's say 8 times earnings, and it looked like they were never going to come back, and then all of a sudden new products, things really start to move. So it's a combination, the stock price performance is really a combination of earnings growth and the multiple increasing as well.